Rupal Agarwal is a director at Asia Quant Strategist at Bernstein. Rupal, good to have you with us. And, we're now looking at 2021 as the year potentially of value investing coming back, given the kind of action we're seeing across equity markets. Tell us, Rupal, how you see things panning out. Do you really see any red flags as we kick off this year, given that what's happening on the yields on Wall Street has spooked a few investors? Or do you see this being the year of a recovery?
Hi, thank you so much for having me. I think in our sense, this is clearly the year for recovery. And in fact, in India, we've actually seen a comeback of value, much early on. So since March, when the market started rallying post the pandemic, we've seen a very, sharp recovery in value in India. And it's almost 100% up as a portfolio, right? So value traders, this is probably, that one big recession that a lot of value investors have been waiting for a long, long time. And we believe that, there is still enough headroom to go from here. And specifically, if we look at, the kind of pickup that we've seen in yields or inflation globally, my sense is that, that is, in fact, much more favorable for value stocks because these are cyclical stocks which tend to work, better in early parts of the cycle. And moderate increases in inflation and yields are actually healthy signs that the economic recovery is playing out. I think what will be worrisome is if, these very sharp increases in yields or inflation could potentially change, some of the broader policy action that we are seeing, globally. So until unless that happens, it will continue to, be much more favorable for value names in India.
Okay, fair enough. When we talk about value, it's such a broad, spectrum, Rupal. How would you narrow it down somewhat in terms of the ways in which you'd identify pockets of opportunity? Would it be sectorally, companies with less debt? Would it be mid-caps that have managed to perform during this time? How would you really, narrow that focus?
Sure. So I think you're absolutely right. There are multiple ways to, define value, and the way that you define value could potentially have a huge impact on your portfolio returns. So it really depends on, your investment horizon. So if you're really looking at a shorter term, exposure to value, we would recommend looking at your deep value names in the region, which is essentially picking up the cheapest names across the market based on, say, a simple price to book metric, right? So these are the names which tend to benefit a lot during these very sharp value rallies, at least tactically. But if you're looking for more of a medium-term exposure or, even exposure into value names across, say, beyond 1 year, in that context, what we would recommend is looking for high-yielding companies. So not just pure dividend yields, but also, the kind of free cash flows that they are able to generate. Because historically, we've always seen that these sustainable yield stocks, tend to outperform the markets over the longer run. They tend to, give robust returns across macro cycles. And hence, for a longer term value exposure, that is what we would recommend. In terms of sectors, it would clearly be more, we would be more sort of exposed to cyclical sectors like energy, utilities, materials, financials. And we would stay away from a lot of your defensive sectors like healthcare or even some limited exposure to technology, because these are clearly sectors which are more high quality sectors. They've done very well in 2020, so they're more 2020 leaders, and now it's more about rotating out of those 2020 leaders and into more of your risky and cyclical names.
Sure. Rupal, wanted to understand whether there is global evidence that value is going to win if yields even do spike up and show resilience at a time like that. Could you draw up a comparison as to whether or not this has happened globally, and you believe that India as well would do well with staying put with value?
Sure. So in fact, what we've seen globally, the pickup of value has been slightly slower than what we've seen in India. So as I mentioned, in India, we've seen a through and through cyclical rally since March. But globally, including in Asia or, in other parts of the world, we've seen these very short instances of time where, value did well, which was, more sort of picked up pace after the entire vaccine development in November. And this year, again, early parts of the year, we saw very sharp value rallies, but then that again fizzled out. So I think globally, what we are seeing now is a much sharper rally, and hence, there will be, sort of trickle down effects even in the Indian context. And the global value rally, we would say, has just begun. Again, historically, a pickup of yields and inflation is something that has always held, say, a US value or, global value. And in fact, this is something which was potentially missing for all these years when value was underperforming most of the other styles. And hence, these macro variables will continue to support value globally, including India.
Sure. How long could this value cycle last, Rupal? Because what we've seen is that growth has won and held out as opposed to value for the last 5 to 7 years. And typically, this is a cycle of 5-7 years that plays out. But would you say that maybe the growth story for value could be a little short-lived right now? Or would you say that this is a sustained period and this is going to extend itself into, more than a couple of years?
So if we compare it to, what we've seen historically in terms of these tactical value rallies, they've varied in terms of the length of the period, right? So we've had periods where it went on for around 9 months. We'd had instances, say, post GFC, when it went on for almost 2 years. So it's very hard to pinpoint, what could potentially play out this year, but my sense is that we are already in the value rally for almost a year now, and we are not really looking at any signs of that abating. So my sense is, at least for the next 3 to 6 months, we can continue to see sharp value rally. Now, whether it sustains beyond that, I think, as I mentioned, it would boil down to the fact that how you are taking on those value exposures. So if you're sticking to your higher yield stocks, I think their investors can continue to, get much more returns even for, beyond the next 3 to 6 months.
All right. Thanks so much, Rupal, for joining in and sharing with us your outlook as to where you're seeing value outperformance, the key risks to the recovery story, as well as the earnings upgrade cycle.